Annuities, I like to jump in with annuities. Let me see, mute upon entry, play, join, leave sound. Okay. So annuities, it's the reason people get it confused, bro, is because they think that there's all these different types of annuities, and there really isn't. It's just one, and there's only one annuity. But the problem is that right here, for example, right here it says single premium annuity, level premium annuity, flexible annuity, deferred annuity, immediate. All of a sudden, you start thinking, damn, how many annuities are there? But it's really just one. It's just that this, the characteristics of that one annuity are all here. Okay. So, for example, how are premiums paid? So, the annuity that I'm talking about, that one annuity, how can you pay into that annuity? Well, you could pay for it single premium, one big payment. You could pay for that annuity with level premium, so monthly payments that are fixed, or you could feed it money, right? You could save money by flexible premiums, which is this month I'll give 500, next month I'll give 1,000, so it's flexible. You see that? See that? So you're feeding the same annuity. It's just that there's different ways to feed into it. Okay, one big payment, fixed payments, or flexible payments. That's it. All right. Next thing about that one annuity is when do benefits begin? So benefits, when it says benefits in an annuity, is when is it receiving income? When is it paying out now? Because annuities is really an income instrument. Question? No? So you could get income immediately or you could get income later on. When you see the word immediate annuity, it means that it's paying out within 12 months. Deferred annuity after 12 months. Okay. So here's an example. My dad, for example, my dad retired at age, what age? 62 or something like that. He, well, actually, he doesn't have an annuity, but let's just say he got those, he worked for Marriott's Desert Spring and he accumulated $220,000. Okay. I talk about it all the time, right? And let's say he put that money into an annuity. So what did he do? He put a single premium into that annuity. And he retired, so he needs money right away. So he got an immediate annuity. It's the same annuity. All right. You getting it? And how are premiums invested? So now this is how the money grows. The money inside the annuity grows. Is it fixed rate of return? Is it a two fixed usually is like 2, 3, 4%. But on the test, they don't ask you what's the average interest rate. No. They just say fixed means that it's a guaranteed rate of return, a guaranteed minimum, guaranteed interest rate. That's fixed annuity. A variable annuity, the money's invested in a separate account. It's invested in the stock market, and if you could make money or you could lose money. Okay, that's a variable annuity. Equity index annuity is invested in the S&P 500. It mirrors the stock market. It's like the stock market, but it's not the stock market. Okay. Anything that has the word variable is the stock market. Okay. So I know um it's confusing. It's kind of confusing when you see the word equity because equity really means stock. Like equity means like stock, the stock market. But it's not invested in the stock market. It's kind of invested in the stock market when you see equity index. It's invested it's not invested in an index. It's invested in a way that mirrors the stock market. That's what equity index means. Okay. And what mirrors the stock market? The S&P 500 is the best way to mirror the stock market. Okay. Um, Market value adjusted annuity, I'm just gonna leave it alone. I keep forgetting what it is, but these are the three main ones that they talk about. Okay. When you see the word variable, no matter what, okay, whether it's a variable annuity or variable universal life, any variable whole life, whenever you see the word variable, it means that it's invested in the stock market and you need a securities license to sell it. It's placed in a separate account because it's risky. Like let's say this is your pot of money right here. You don't want to leave your money. You don't want to put your money, mix it with a client's variable account because what if I lose my money? So I want to put the client's, if the client wants a variable annuity, I'm going to put his money in a separate account because I don't want like if he loses money, it's on the client. I don't want to lose my money. My money is in the general account. Does that make sense? So that's what variable is all about. So variable annuity, equity index annuity. All right. So for example, my dad most likely we would have put him in an equity index annuity. It's the same annuity, right? He fed it with one payment. He's getting money right away, and it's invested in invested in a product that's kind of like the stock market. It's the same annuity. You see that? So that makes it easier for anybody to understand because that's what kicks everybody's butt when it comes to annuities. All right, so now he's immediately making money. So now how is he going to get the money? And these are all the ways that you could get money out on a variable annuity. It's called in the test they call them settlement options. Settlement options. Okay. So settlement options means how is the client getting his money? So right here it says a straight life. This is what we're going to focus on a lot, all right, bro? So this one's really important. Okay. Straight life. What does it mean, straight life? Straight life means that you get income for life. It has the word life. And it's the same monthly payment, it doesn't change. And it pays even if the client lives like a long life. Like let's say the client lives 200 years, just an example, right? I'm exaggerating. He even if so the money's gonna run out by age 100, but if the client lives to age 200, the insurance company still has to make payments even if there's no more money in the account. That's how straight life works. Okay. So I said 100, I just made up a number. Okay. It's not necessarily 100. It's just that if the client lives a long life, it'll keep paying. Refund life is the same thing. It's a fixed monthly payment, but when the money runs out, the payment stops. It's refund life. Okay. Oh, here's another one about straight life. What if the client lives only 1 month or 3 months? They only get three payments, right? If the client dies after 3 months, there should be some money left over, but who gets that money? That's a question on the test, okay? And the answer is the insurance company keeps the money. There's no money on straight life. Beneficiaries get nothing, even if the so why would anybody get it? Well, the client's thinking, I ain't gonna die anytime soon, you know. They're not betting on dying anytime soon because the people like straight life because the out of all these settlement options, straight life has the biggest monthly payment. So people like obviously the bigger the better, right? So, but just know that if you die early, you lose all that money. And the client's like, that's okay. I ain't gonna die anytime soon. I like a big payment. That's what's going through the mind of the client. So that's how straight life works, okay? Refund, if you die early, the payments still continue to the beneficiary because it's refund. You still get all your money no matter what. Any questions on that? Life with period certain. Life with period certain, the client gets money for a certain period of time. Let's say 20 years, for example. So what happens after 20 years? If the client is still alive, then the payments still continue, even though you're done with the period certain. Okay. What if the client dies before 20 years? If the client dies before 20 years, then the payments continue to the beneficiary. When the 20 years is over, payments stop. Okay. Because it's not paying the actual annuitant. Okay. Any questions on that? No? All right. So you explain to me how straight life works. Or if they die early.
Insurer keeps the money.
Okay. Refund life.
Pays out until they die, even if the money runs out. If they die before the money runs out, the beneficiary gets the money.
How about life with Pearson?
period to money
Mhm.
right before the period, the beneficiary continues to get the payment until the period ends.
Mm. Good. All right, perfect. Okay. So in the test, when it says, which of the following is a life contingency option? It's these three. Life contingency. So it's contingent upon the person dying. Something happens when the person dies. All right. Next one, single or multiple. So joint life, joint and survivor life are covers. See this, these three cover just one person. These right here cover two or more people. Joint life covers two or more people, but when the first one dies, payments stop. Joint and survivor pays two or more people, and the payments continue until the last one dies. Simple as that. Any questions? Annuity certain. Fixed period is when the client says, just pay me for 11 years. And then the insurance company says, all right, they do their calculation based on 11 years and how much money's there. And then it says, you're going to get this monthly payment based on those two things. They just do simple math. Fixed amount is when the client says, again, the client says, give me 11,000 a month. And then the insurance company does a calculation and says, all right, you're going to get 11,000 a month, but it's only going to last you 4 years. And the client's like, I don't care. I just want 11,000 a month. Pretty simple. So when you see fixed period, the client chooses a period. When you see fixed amount, the client's choosing the amount. Okay? That's pretty much it on annuities, bro. I mean, here's a cool little visual. Annuities, there's the accumulation phase, and then there's the annuitization phase. Annuitization phase is when you're paying out the money, the monthly payment. And the accumulation phase is when you're basically saving for retirement. This point right here is retirement age, the middle point. Person retires. Simple as that. See that? So how premiums are paid, that's the accumulation period. See that? When do benefits begin? That's the annuitization period. How are premiums invested? That's the whole entire period. Because while it's in the accumulation phase, it's invested. And while they're pulling money out, the money's still being invested. So this one is both. How long do the benefits last? Well, that's the settlement options. That's annuitization. Settlement option is taking money out. That's it, bro. That's all chap. That's 8 questions right there. You're gonna get 8 questions on all of this right there. Pretty simple, right? All right. Let's go over whole life. Whole life is pretty cool. Whole life. Whole life insurance is it okay, whole life insurance matures and endows at age what? 100. At age 100. Whole life, the only product that endows or matures at age 100. What time you take your test? 5 o'clock? You got plenty of time, bro. We're gonna master this thing. Hmm. All right. So whole life insurance is also known as straight life. Okay. What does the word paid up mean? It's kind of like matures and endows, but not really. What is it? What does it mean to be paid up? Yes, 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 you got it. All the payments have been made. That simple. Normally, the payments are made like level premiums and they end to age 100. That's the normal way of making all the payments. But there's a whole life called limited pay whole life, which means that you're gonna pay it up early, not to age 100. You're gonna pay it up early, and then it's gonna be paid up. But so that means that the payments are gonna be more expensive because you're paying it up early, just like a debt. You could also pay for a single premium, just like an annuity we talked about. But there's two of them that are kind of weird, okay? These three that I just mentioned, those are easy. They make sense. But these two are the weird ones. Modified whole life means that the premiums are going to start really low, lower than the regular premiums. But then all of a sudden, bam, they're going to get modified and then they stay level to age 100. That's called modified. The other one is graded premium. Graded means that it also starts low, but it gradually goes up. Instead of all of a sudden, it gradually goes up. Graded premium. And then it stays level to age 100. Any questions? On the test, is gonna want you to know that face amount is the same thing as death benefit, which is basically the life insurance coverage. All right. Whole life, what happens at age 100? It matures, it endows, but what like technically happens? The policy ends, yes, and then what else? Does the client get anything? All right, they do. The client, if they reach age 100, which come on, what are the chances of people reaching age 100? People do, but what the vast majority does not. But if this client has a whole life and he does reach age 100, the policy terminates, like you said, but you also get the face amount in cash. So you see this blue line right here? It's the cash value line. Cash value starts at zero, but it eventually reaches the face amount. So basically at age 100, you get the cash value, the face amount in cash value. So the policy ends and, and you get the coverage in cash. Sounds pretty good. But you pay extra for this benefit. Whole lives are more expensive, right? All right. Any questions on whole life?
No.
That's pretty much everything you need to know on whole life, okay? So if you got that, you're gonna they could ask you any way they want to, and you'll. So term insurance is the only thing that does not build cash value. Whole life does, universal life does, term, no, no cash value. Okay, let's see. Surrender charge, you know what surrender charge means? What is it? What do you know about surrender charge?
So the policy you get one.
During that time? Hmm. Yeah. It's a fee. It's a fee for canceling early. Yes.
Yeah.
Okay. Universal life also has a surrender charge. So whole life is known as straight life. Universal life is known as flexible premium adjustable life. Okay. So you see the premiums? There's another green line right here that's going all over the place. That's because premiums are flexible in universal life. Okay. Universal life has a term insurance inside of it. It's called annual renewable term. Basically, that's how the cost of insurance goes up because of the coverage annual renewable term. Whole life doesn't. Whole life is just this is how it works. There's no term insurance in it. It's just you pay up the policy, and at age 100, you get the cash value in form of a face amount. I mean, you get the face amount in form of cash value. But oops, where'd it go? Does that sometimes. It's weird. But in universal life, The cash value, you notice how goes up and then down? It goes up and then down because at this point right here, the the cost of insurance is more than your monthly payment. So in order to keep your monthly payment leveled, they have to take from somewhere to compensate for the increase in cost of insurance, which is now more than your monthly payment. And they get that from the cash value. That's why the cash value goes down. Any questions on that?
There you
All right. So
go.
you see like how the cash value goes up and then it reaches a point where it starts going down. All right, now that's there. The red line is the monthly payment of cost of insurance. So the monthly, okay, the cost of insurance, so like the insurance, the face amount of let's say $300,000 goes up every year. That the cost to pay for that goes up every year. But the premiums don't go up every year. The premiums stay leveled. So the premiums stay level, but inside the policy, the cost of insurance is going up and up and up and up and up and up every year. Where once it reaches a point where it's more than your monthly payment, then that difference, they're taking it from the cash value to keep the payments the same. So you see how the payments stay the same, but the cost of insurance is going higher than the monthly payment. So where are they getting the difference from? From the cash value, and that's why it goes down. Okay. So I like to show this because I want you to remember that the cost of insurance goes up every year. It's called the annual renewable term. Maybe that's not a good way, but
So the cost of insurance is the base amount.
yes, yes, cost of insurance is a face amount of the policy. But it's growing cash value too, because some of that money goes to cash value and some of the money goes to the cost of insurance. But once the cost of insurance is more than your monthly payment, then they're going to take it from the cash value. All right. There's a lot more on universal life, okay? Here's another one. Universal life, there's a thing called, oh, come on. Keeps doing that. All right. Universal life, there's death, two types of death benefits. Option A or option B. Okay. Option A is called level death benefit, which means that you're gonna get whatever the insurance coverage is. So if the policy has a face amount of $350,000, if you die now or later, you're gonna get $350,000. That's called level death benefit. Option A, level death benefit, option A, level death benefit, option A. Don't forget that, okay? That's gonna be on the test. Option B is an increasing death benefit. Increasing death benefit means that let's say you start with 350,000, but the cash value is actually, let's say the cash value is 50,000. So instead of getting 350,000 on option B, you're going to get 350 plus 50, which is a total of 400,000. That's how option B works. It's an increasing death benefit. It increases because the cash value is increasing. Any questions? Option A, option B. Yeah. So if you ever see option A or option B, it's talking about a part of the universal life product or flexible premium adjustable life. And it's just telling you that, what option, there's two options that the client could choose. Okay. That's it. That's on the test. The test is not gonna want to know which one's better. They don't want you to know that. What's the best of them all? Universal life, whole life term? They don't ask you that on the test. Okay. Any questions?
No.
All righty. That's pretty much it on whole life and universal life. What if it has the word variable or variable whole life, variable universal life? What does the word variable do to the product? What is that all about? Yeah, yeah. And it's in a what kind of account? Mm-mm. Is is it's either in a general account or a separate account? What is it? Anything that has the word variable is in a what type of account? General or separate? Hmm. Yeah. Just think of it like that. Variable means risky, so I want it separate because I don't want to mix it with my money because it's risky. So I want it separate. Right? Variable, risky, separate account versus general account. You need a securities license to sell anything that has the word variable. FINRA and SEC have to approve it. Hmm. We were gonna have two people study with us, but it's like that. Decreasing term, also known as credit life or mortgage redemption. How do you remember this? Decreasing, what decreases? A face amount and the death benefit. Same thing, right? It decreases all the way down to zero. When the term ends, the face amount is zero. Okay. Why? Because you banks and insurance companies like you to get insurance in case you die, then they get their money, right? That you owe them. So some banks won't lend you money unless you have a credit life policy. Because if you die, they don't want how are they going to collect their money, right? But if you die with credit life, then they get their money. They're the beneficiaries. So so that's why it's credit life. And you think of decreasing term has to do with credit life or mortgage redemption insurance because they want their money back. But once you pay off the debt, then you don't owe no money. Therefore, the policy terminates because you don't need it anymore because you already pay off your debt. The premiums stay leveled on these type of policies always. Now let's look at increasing term. It's the opposite, right? Premiums are leveled, but what increases? The face amount, same as over here, only that here it decreases. So why would it increase? It's called a return of premium rider. So anything that has a return of premium, that means that, you know, let's say you get a term insurance, a 30-year term, and you paid into the 30 years, you paid into like $25,000 of premiums. Then an increasing term, what it's going to do is it's going to give you the $25,000 in premiums back to you in form of a check. Where do they get the money from? They charge it in advance because the coverage is going up to eventually return your premiums, the 25,000. Get it? So anything that you hear the word whenever you see the word increasing term, you're thinking return of premiums. When you see the word decreasing term, just think of debt. What debt? What decreases? The 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 debt amount decreases every year. So you're thinking of credit life, mortgage redemption, decreasing term. Does term insurance have cash value? No. Okay. Level term is easy, right? Level term, the face amount stays the same and the premiums stay the same. What happens after the term? When the term ends, you could do two things. You could renew it or convert it. Renew it means give me another term, but it's going to be more expensive because you're 20 years older in the example I gave you. Make sense? And no, if you renew it, you don't have to requalify.
It's just well, this, no, no, no.
No, cost goes up based on your age. Convert it. Convert it means you convert to what? Remember? If you renew it, it stays as a term. But if you convert it, it turns into what?
Now.
Actually, it's rare. I just noted
Yeah.
that. It converts to a permanent policy. So it goes from term to permanent, like a whole life. So they switch it on you. And then so that's three terms. The fourth type of term is the one we talked about. In universal life policies, annual renewable term. Okay. It renews every year. Cost of insurance is going up every year. Okay. Let me see. Okay, dividends. Let's talk about dividends. Are dividends, what is a dividend? It's right here.
Surplus, right back annually.
There you go. So, yeah. Are they guaranteed? They're not guaranteed. So, here's one way to remember. Just think the injustice, right? They overcharge you, and because they overcharge you, they're going to give it back to you, but they call it a dividend, but it's not guaranteed. That means that they might not give it back to you. They're going to keep it. For what? They're going to keep it to offset the profit. In case the company doesn't make money, you're paying for their losses. Crazy, huh? Dividends are not taxable. That's obvious because they're refunding you back your money. You already paid taxes on it. You're not going to get refunded. You only pay taxes if right here it says how the interest only option. So if when if they do give you a dividend and you say, I don't want to just save it for me and let it gain interest. Well, that interest that is going to gain, you are going to have to pay taxes on that. Make sense? Paid up additions, just think of whole life. If it's paid up, you said it yourself. That means that it's paid up till age what? You could use it to reduce your premiums, cash out, or get a 1 year term. So you're gonna get additional coverage just like paid up, but in this one in 1 year the coverage ends. So think of this. Have you ever heard of the insurance company Mutual of Omaha? How about Northwestern Mutual? Yeah? Here. Let's do this so that it's a good visual. Mutual of Omaha. Let's check them out. Here's their website. Right? Here's their logo. Mutual of Omaha. It's a life insurance company. So mutual, anything that has a word mutual, that means that it pays dividends. It's a mutual company. That means it pays dividends to its shareholder. Basically, what it means is that, hey, if you come with us, we're gonna overcharge you, bro. And you might not get your money because dividends are not guaranteed. Literally, that's what it is, bro. Look at this. At Mutual of Omaha, you can always count quality coverage, budget-friendly rates. We help the insurance that benefits your financial. Oh, wow. So generic. Let me see. Let's look at where it says that we pay dividends, blah, blah, blah. Watch.
T whole life insurance.
Check it out. It doesn't really say here. This is like a sales, very generic.
Yeah.
Guarantee whole life medical. All right, let's look at this. Give me a quote. Yeah,
10,000, 25,000.
yeah, it doesn't say the benefit. What you receive, it says guaranteed insurance, benefits, no medical exam, claims. Most claims are paid within 24 hours, 30-day money back guarantee. It, what's graded death benefit, guaranteed whole life benefits? Additional benefits I receive, you'll receive benefits inclusive customer discounts. Man, this is so generic, dude. It has no details here.
You just telling you what you want to hear. Oh,
Let's look at the next one. Northwestern Mutual. This is worth it, okay? All right. Northwestern Mutual. Let's click on it. Um, best conversations, number one, life insurance, consumer experience, top five independent investment brokers, dealers. Yeah, it doesn't say much, but again, it says the word mutual. See that? So a mutual company is here, let's do this better. Name all the life insurance companies that are mutual companies. Is We're gonna ask some Chad for some questions here. Here it is, right? Northwestern Mutual, New York Life, Massachusetts Mutual, Guardian Life, Penn Mutual, Mutual of Omaha, Forest Financial, Lafayette, one. So mutual insurance companies are owned by policyholders rather than stockbrokers because they structure profits. If the company performs well, are often shared by policy owners, often in the form of dividends. You see that?
yeah.
Many companies list it, but dividends are, again, in the test, it says they're not guaranteed. And what is a dividend for a mutual fund company? It's an overcharge of payment of premium. And we don't even have to chat GPT it. That's on the
Mhm.
book. All right. So mutual companies versus what? Stock companies like Primerica, for example, we're not a mutual company. We don't overcharge. We are a stock company. So stock companies pay dividends to shareholders, but mutual companies pay dividends to policyholders. Okay. And participating policies are policies that pay dividends. Non-participating policies are policies that do not pay dividends to policyholders. Make sense? All right, so that's pretty much all you have to know about dividends. How about this one, bro? Non-forfeiture options. What do you know about non-forfeiture options? I'll give you like a little tip right here. Remember? So just think of this. Non-forfeiture options are only for policies that have cash value. Okay. So let's say we got this guy right here who has a coverage of a face amount of 300,000 and then he loses his job. He's actually broke and he has no money. But in his policy, in his cash value policy, he has a cash value of $15,000. But he can't make payments no more. So the insurance company says, "Hey, don't worry, we could use that cash value so for something. Let's put it to use. And you don't worry about making a payment." And the client all of a sudden is like, "Oh, heck yeah. What are my options?" Number one is you could cancel the policy and just cash out. Number two is called extended term non-forfeiture option. Extended term means, hey, I want the same coverage, but because it says term, the cash value is only going to pay that coverage for so long because you're not making no monthly payments anymore. Makes sense, right? So again, extended term, the face amount stays the same. Reduce paid up. Now you have to reduce the coverage. So that face amount goes down, let's say, for example, $100,000, but at least it's paid up to what age? When something is paid up, it means it's paid up to age 100. Reduced paid up. It's in the word. Any questions on this?
No.
Make sense? I already went over settlement options, so we don't have to go through that again. Hmm. Waiver of premium. That's good. We'll just go over this over here. All right. So right here, the application process. When you submit an application, it goes through underwriting, and underwriting either declines a policy or issues a policy, right? During the application process and underwriting process, there's a thing called conditional coverage. What does that mean?
Approved or denied.
Yep. The policy is approved or denied. Covered.
Covered for set period of time or whatever.
Mhm. All right. So now, once a policy is issued, it's going to be issued at a specific risk classification, which is standard, substandard, or preferred. Standard means just regular rates, obviously. Substandard means it's going to cost a little bit more you're because a client is sick or has diabetes or whatever. Still gets issued though, so it's not that bad. Preferred means, man, this guy's super healthy, and we're going to give him preferred rates, which is cheap, very inexpensive. Once the policy is issued, then it enters a thing called a free look period, which is 10 days or 30 days if you're older the age of 60 years old. Free look begins when the policy is delivered too. You want to know that. When does the free look period begin? It doesn't begin when the policy gets issued. It begins when the client actually received the policy either by email or, physically. Make sense? When a policy is issued, the coverage actually begins. If the client returns the policy during the free look period, what happens? Policy is terminated and you get a refund. You get your money back. What happened was the client misses a payment. Does the policy cancel right away? No. There's a thing called a grace period. Okay. In California, there's a 60-day grace period. So during that time frame, you could catch up with your late payments and keep making regular payments. If you die during the grace period, what happens? If you die during the grace period, does it pay?
Yeah.
Yeah, it does. That's why it's called grace. After the 60 days, what happened? Well, two things happen. The policy lapses and you have no more coverage. Or if you have cash value inside the policy, then there's a rider called automatic premium loan that is going to kick in, that is going to keep the policy active until you run out of cash value. Again, that's after the 60-day grace period. Okay. Once the cash value ends, you got to keep making payments as usual, or else what's going to happen? Your policy is going to lapse. Any questions? Okay. If the policy lapses and you still want it again, you're going to have to do what's called a reinstatement. A reinstatement is going to have you pay back the premiums you owe because it saves your age and and you must go through underwriting. So you have to go through the process of qualification again. That's why people reinstate it. Because if you don't reinstate it, then you just start a new policy. But now it's going to get issued at your current age, not at your issue age, which that's why reinstatement saves the age. Any questions? That's pretty much it on this. That's the process. So that allows you to kind of like put the whole pieces of the puzzle together on a life insurance policy, connecting substandard, free look, grace period, lapse, reinstatement, all that good stuff. ¿Está bien, verdad? It's good, right? All right. Speak to you in Spanish like as if you know Spanish like perfect. Okay. Waiver premium. It's a disability benefit. How does it work?
Say both payments will be made by the insurer, or I guess out of the cash value.
Yep.
Only completely disabled.
Mhm. And payer benefit rider works exactly the same, but that's when you have a policy for a minor. Okay. And it makes the payments for your policy. So that means you have free insurance until the minor turns 21 years old. I think we're good here, man.